Just close that out of the way, move the chat box down there. There we go. And just to start with, I'm going to go over to oil in a minute because I just want to show you a terrific VPA example that came in a little while ago and is actually developing. Sorry, I'm not hearing myself in my headset. That's better. There we go. You can. Okay, great. What we've got here, we're on the multiple indices. So we've got the YM, the NQ in the middle, and the ES on the right-hand side. And if you're trading any index future, whether it's the Russell or any of these, you should have all of these up at the same time because they give you different perspective in terms of volume and price action. Generally, they're moving in the same direction, but not always. Just wind that up a little bit. Move that up a little bit. There we are. So we've got this bearish sentiment which is developing. This is the daily we've got strung across the bottom. The longer term trend, as Anna said, is bullish. The NQ daily is probably the most interesting of the three. I've actually done a post about this, particularly with regard to this level of resistance. It was resistance yesterday. Of course, it's now acting as support today. It will be fascinating to see if that does come into play. Below that, we've got the volume point of control, and we have another level of potential platform of support here also. Clearly, this is reacting to the employment data. It open gapped up. It's selling off, but as I say, we've got this platform in below here. So even as an intraday trade, if you're trading on this 5-minute chart, we've got a nice little move going on. Let's stick with doesn't really matter which one we go to. Just pop that up there. There we go. Oh, go to the YM. That was the one Anna was on. Let's go to the YM. There we go. This is what we're seeing. We saw that little rally. We saw a decent amount of volume coming in under this candle. So there was some buying coming in here. You could see it reflected in the volume and the price action. It's anomalous. If it weren't, then this will be down here somewhere. It hasn't, so it's closed up here. So there's buying coming on that particular candle. But then you see the rally here. This is on the 5-minute chart. You've got a falling in volume. You've got spreads which are narrowing. It doesn't look terribly strong. And it's one of the many applications of volume price analysis, this understanding of interpreting whether a reversal is a reversal from a primary trend, in this case from bearish to bullish, or what we are witnessing. Are we simply witnessing a weak pullback into a secondary trend? In other words, a minor pullback or a minor reversal. And that is just fundamental to trading success, because if you can do that, and volume price analysis methodology teaches you how to do that, then that will help to keep you in a position and maximize the profitability from it, and not get out all the time when you get a minor pullback or reversal. And that's what happens to most traders. They've got some profit in the position, the market moves against them, they panic, they close out, and they're actually closing out in a minor reversal or pullback, and the market continues in the original direction. And of course, to assist in that, you've then got the trend monitor below here, which is just steadfastly red for the time being. It hasn't flickered, there's no change, it's just holding you in that particular position. It's not suggesting that the trend is weakening or likely to reverse at any point soon. So that's the application of VPA in conjunction and supported by the quantum indicators. So that's where we are at the moment. It's not a price waterfall that's developing, it's bearish sentiment, but it's not falling out of bed right now. So it's a question of treading lightly, having your stop loss in the right position. I mean, if you're trading this right now and you wanted to get into this position, or you're in this position, perhaps you've got in up here somewhere, you'd have the stop loss here. Maybe as this one breaks, you'd maybe move your stop loss down to the next level and hopefully lock in some profit as you go. Obviously, you'd have this in multiple time frames, which is what I've got set up over on the other chart here. If we go to, where are we? Here we are, indices in multiple time frames. Right. Here I'm onto the NQ. Exactly the same principles. This is the 15-second. I've got the 2-minute. I've got the 5-minute here. This is the 10-minute, 15-minute, and right over here onto the daily. We've got that support platform coming into play. That's what we're keeping an eye on. And it's one of the important factors in terms of trading, which is using multiple time frames. What we're seeing on 15-second right now is moving up to the volume point of control. Very little else that we can conclude from this right now. We just have to wait and be patient. A little bit of buying coming into this candle here, but it's still looking pretty weak. So let's just hop over onto oil for a moment, just to see where that's going, as that was developing a nice trade earlier on. And what I wanted to show you really was, if we start with the 3 minute, 4 minute, 10 minute across the top, and then 15, 30 and daily down at the bottom. In terms of the daily, this is where we are. That's the key candle. That was the huge volatility spike. We expect to see the market congest within this region for some time. It's what we're seeing. It's what we expect to see. It ain't going anywhere fast at the moment. But in terms of intraday, this is what came up earlier. And really, your eye is automatically drawn to the high volume and low volume and the associated price action to give you those signals, which then tell you what is likely to happen next. We saw the move away, we had volatility, that's fine. The next candle comes, a ton of volume going in, this one here. Okay, we get a signal of weakness. It's a first signal that the market is perhaps weak. There's a lot of selling in that particular candle. The next one comes along, indecision, okay, fine. The next candle follows through, that doesn't look too bad, still got some selling in there. But then we get to this candle here. Prior to that, we've got selling, increase in selling, so we've got a market that's falling, so we can see the selling pressure starting to increase. We've got rising volume and falling price, which is good. Then we get this candle here, big wick to the upper body, ton of volume under it. In conjunction with this one here, this is now telling you this is a structurally weak market. Now bear in mind we're looking at one chart here. We're also starting to hit resistance, this blue line on the accumulation distribution indicator, which is based on price. So that is giving you a heads up that yes, there is resistance in that region anyway. It's testing and retesting that level from a price perspective. You then move up maybe to the 10 minute. What is the 10 minute telling you? First of all, we've got weakness coming in here. We've got a decent wick to the upper body, a ton of volume coming in here. The next one, exactly the same amount of volume and even narrower spread, another big wick which goes up here. Maybe you can't quite see it, but that's where the top of it is. So we've got further weakness coming in here. And then we've got third candle, slightly lower volume, but again, very, very weak. This is now, you put these three together, you know, this market is not going to rise dramatically. It's more likely to go into congestion or it's more likely to reverse. And that is precisely what it's done. And that is purely based on looking at the price action across 3 time frames. You have the same prospect over here on, this is on the 4 minute, doesn't really matter whether it's 4 minute or 5 minute, gives you the same sort of principles. We had long-legged dojis coming in here, indecision. We had lots of volume going in, not really going anywhere. We've also got a volatility candle, so we're expecting some congestion and possibly a reversal, and that is what it delivers. And the point about it is that it doesn't really matter what the symbol is at the top of the chart. It can be an index future, it can be a commodity, it can be a stock, it can be anything you care to name. It really is almost irrelevant what it is at the top of the instrument. Obviously, you've got to know what you're trading and the size of lot size and contract size and everything else. But the principles of volume price analysis can be applied to any chart, any time frame. It doesn't matter what the instrument is or the market is. It just gives you all that information. And then if you go down onto the 15 minute, exactly the same again, absolute, it just screams out, you've got so much volume being driven into this candle here. It's just telling you it's weak. The following candle confirms the weakness, and then we go down into this nice move. Now you might not think that's very dramatic, but I can assure you going from $18, $20, $18, $30 a barrel down to $17.60 or $17.50 is worth a decent amount of money in this contract. And then you're back to analyzing the chart again. Well, where are we now? What are the indicators telling us? Where's the price action? Well, then you're back to levels again. You're looking at the potential opportunity. Where is this market going? First of all, we've got the volume point of control, which is where we expect the market to pause at and congest because it's the heaviest concentration of volume on the chart. So it's no surprise when the market congests at that region. We've then got price-based levels. We've got this red line and we've got this blue line, both relatively thick. The way the accumulation distribution indicator works is every time a level is tested or retested, that line thickens. So it gives you an instant visual representation of strength and weakness and how strong those levels are. So these levels down here, you may not be able to see the numbers. This is ×2. In other words, it's been tested twice. This is only once, so it's pretty thin, as indeed are these down here. These have been tested multiple times, 8 times, 7 times, 6 times. And the line thickens accordingly. So it tells you that, yeah, we've got some serious support here, or we've got serious resistance in this region. This is a decent level of resistance that was hit. It's bounced off there, 2-bar reversal, come down. We've got an effort to rally. Again, simple principle, trying to rally, volumes falling. So what do you expect? Well, you're not expecting the market to go very far. As Anna said, if you've got a market that's trying to rally on falling volume, ain't going far. And the same is true in reverse to the downside. So we're now waiting for this market to break. And in terms of a trading opportunity, we obviously need to wait for it to break away from the volume point of control. And then when it does, that is when the volume histogram, which is associated with the volume point of control, then comes into play. Because first of all, the volume down here, the linear volume, if you like, the linear relationship between price and volume will give you a heads up as to whether that breakaway from the volume point of control is genuine. If it's genuine, it'll be confirmed with volume. And then as you move down away from the region and develop a trade, then you're then looking at the volume histogram, in other words, volume, price, and time, which is represented on the y-axis here, as to those levels which are likely to present either barriers of resistance or platforms of support. And if the market broke to the downside in this case, first of all, we've got to break through this level here, this price-based level of potential support. But if it broke through there, then as we get down to this level here, this is a low volume node. The volume here is falling away. So the market should move through here pretty swiftly. And there's very little in the way of price-based support, extensive price-based support below. And there's also very little in the way of volume-based support because it's pretty lightweight. This is the heaviest, this is the lightest. We've got some more down here. But in terms of moving through this region, in other words, it should move through there pretty quickly, which is what you want to know as a trader. So if the market breaks the downside and moves through 1750, 1740, we expect it to move through 1713 down to 1720 without much effort. So it only needs average, if you like, volume to break through that region and down to the next level. And that's what you're looking at the whole time, is interpreting the chart, interpreting the indicators to help to give you the information as to where the market is heading next. Just pop that back down. We've also got the volume point of control here over on 10 minute. We've got it here on 4 minute. Not quite trading around it on 15 minute, but it's very self-evident from the multiple time frames that until the market breaks away from this region, then we're going to have to be patient and wait for the next trade to develop. So for the time being, oil is in price agreement. There's no strong bullish or bearish sentiment to one side of the market or the other. The market is, the fulcrum is the volume point of control, if you will. It's like a seesaw with two equally weighted people either side. So it just sits there, it doesn't move. When one person gets off, or maybe a lighter person gets on, or a heavier person gets on, the fulcrum moves, the price action begins again, and we come out of congestion, and we're back into the whole business of analysis once more. Let's just go back onto the indices and see where we are. Okay, we're starting to break lower now. This is all looking nice. That's on the 15 second. And again, principle is the same. It can be applied to any time frame you care to like. I use this particular time frame a great deal because I like to see what's coming up from the faster time frame into the slower time frames, and I find it, for me personally, it's one I use a great deal. As I say, it's not for everybody. As you can see, it's pretty swift, but as an intraday scalping trader, I just find it works for me. The trend monitor you can see here, we're transitioning through into red. We've transitioned into red. We've got a little bit of a pause here, but over on the 5 minute, we're still staying red. So the indicators are quite happily telling us that for the time being, there's really no significant change in trend. We're still in bearish territory, and for the time being, we can continue holding and maintaining a position short in the market for this particular instrument. Just pop up the daily, just see where we are. See where this level is. It's getting pretty close. It's going to be possibly tested later on. We will see, but it is a very strong platform. And again, even as an intraday trader, you need to have that information. The daily chart, the slower time frame charts, I've said many times before, whatever you see on a slower time frame chart will trump a faster time frame chart purely because it has the weight of time associated with it. So support and resistance levels, anything you care to consider on a slower time frame chart will carry more significance in terms of the technical picture when the price action reaches that particular point. It's another reason for having multiple time frames up in whatever you're trading. Let's just go and see what's happening in terms of the, let's see what's happening on gold. Okay. This has been in congestion for a while. Still bullish, but it's coming off a little bit. Longer term, remaining bullish. And again, you look at this chart, what have we got? We've got a volatility trigger on 3, we've got a volatility trigger on 5, we've got a volatility trigger on 10. Haven't got one on 15 yet, got some buying coming under that candle. What you're expecting to see as soon as you see these volatility traps is the possibility of either congestion or you're going to see a full-blown reversal. If you're waiting for this to develop to the downside further, then you've got to wait for it to clear the bottom of this candle down at 1688. But for the time being, we're in congestion. Once again, you can see these levels are developing, support and resistance above, below. We're trading in the channel, and then to break away from that channel, we're waiting for that to be confirmed with volume. And if you were trading a 3-minute and you didn't have these other time frames up, then perhaps the volatility might not appear on the 3-minute. It happens all the time, but it does happen on other time frames, and that's again the importance of using multiple time frames. Just go to the currency indices, see what's going on there. This is the yen. These are all on 5 minutes. So this is the yen index. This is the dollar index. This is the euro. We've seen some pretty strong euro buying. We had the ECB earlier on today. That's triggered that particular buying. I was going to say frenzy, hardly a frenzy, but you know what I mean. And this is the British pound over on the right-hand side. And that's all reflected over here on the currency strength indicator on 15. This is 15-minute time frame. Decent buying of the pound, just starting to roll over now on 15. We've had quite a little bit of selling on the yen, starting to see the yen kick up. Just seeing what's going on in terms of the VIX. Just pull this over. If you don't have the VIX on your platform, then the place to find it here, investing.com, this is it. Has all the time frames you would need. This is on, I've got this on 1 minute at the moment. Let's just change that over to 5 minutes. So again, it's been moving around. It's hardly been moving strongly. It's quite interesting. There's been quite a lot of odd price action today. As Anna said, we're at month end. And as you can see, this is the yen. So we've seen selling of the yen, and now we've got buying of the yen. And it's not really reflective of what is going on in terms of risk sentiment in the market. So it is quite unusual. And all I would say to you is be aware when you get to month end, you see this these sort of divergence of particularly with the yen when you get to the half year at September, end of September, when it's an accounting period, and also at the end of March. The Japanese are very rigorous in the way and disciplined in the way they repatriate their currency, and you will see that occur at those particular times as well, and also at month end. So it's not unusual, not uncommon. It's just generally out of balance with what we normally expect to see in terms of risk on currency behavior. Let's just go back to the NQ. Let's go to, yes, let's go back to the indices again, multiple time frames. There we are. This is the NQ. We've got a bit of a bounce developing. We'll see if it has any strength or not. Let's have a look at the 2 minute. There we go. Yeah. Yeah, I'm just going to pass back to Anna. Bear with us.